Well, good afternoon, investors. Welcome to actually, it is the Fat Tuesday edition of Bull Sessions. My name is Mark Robertson. I am joined here by Ken Kavula. We are longtime friends and quite long-time investors in our search for good ideas that we would like to try to share with you guys. How are you today, Ken?
I'm doing fine. I see I have three bluebirds on my shoulder today, Mark. Are they just sitting there to give me a hand? What's the purpose of the
They
bluebirds?
they just needed a place to rest this month. You know, they've been floating
Okay.
around our cover page during the entire Twitter adventure with Elon Musk. So if they do whisper any hot stock tips in your ear, please let us know.
Well, you can tell where our demographic is going, Mark. Everybody's arguing about prices now, or lamenting prices. So Len is telling me that he bought a number 7 sub at Jimmy John's and it costs almost $10. So
Oh, yeah, it's something else when you go out there and they want 30% tips now too on top of that.
we,
So,
we had an investment club meeting last night. The model club met, and it was online. So afterwards, we hadn't had chance for dinner. Natalie says, "Why don't you go down to Taco Bell and pick up some tacos and bring them home?" So I went down to Taco Bell and went through the line. And usually I can get away from Taco Bell with 12 or 13 bucks, and it cost me $22 to get through the Taco Bell line.
yikes.
So yikes, right? Uh, just regular tacos, plain old tacos. So
Well, I do have a slide in here that just gently touches on inflation. It's certainly not going away. I do want to warn the audience that we continue to have a little bit of technical difficulties, and I'm trying to troubleshoot. But if I should happen to drop off or whatever, or if we just simply completely crash, I'll just go drink heavily and we'll come back next week. But
Mr. Galagli, Mark, is standing at his front door yelling, "Get off my lawn!" So,
of course he is. All right. Well, we do have Graham Steffen's monkey joining us as a third. He's going to be fairly quiet, but quite the force. But we are going to take a look at that utility demonstration portfolio I warned everybody about last week. Take a little bit better look at the intricacies of it and take it away from there. Happy day after President's Day to everybody. Hope everybody found an activity to enthrall themselves. And Waldo is there in honor of the 23 funds selected for 2023 by Morningstar. We're going to spend a couple minutes with that. It actually is quite a formidable list of funds for those of you that are either looking for ideas or looking for a good growth fund to invest directly in.
I'm interested in the bear mantle, Mark. What is that signifying this afternoon?
Well, Ken, I'm glad you brought that up because I did tell you that I was preparing my trophy mantle.
Okay,
You
I
know,
got it.
a week from today, we hand out the golden statues, and I'm going to need some room up there, I think. So that's
Well,
just a little foreshadowing.
does that indicate how well you've done in the past, or what is that indicating?
Oh, well, yeah, that's not exactly the way I tend to frame it, but you do have a point. I mean, Hugh McManus takes away trophies in wheelbarrows, and the rest of us are just average. Well, I'm going to try and catch up a little bit.
Okay, all right.
Thank you for bringing that up. And of course, that pastry in the middle, for those of you that are not familiar, it's not something I was familiar with until I moved to the Detroit area in the mid 1990s. The Polish community here is just festive about these pastries called Pączkis. And actually, I believe it's Pączki, and that's plural also, Ken. Is that correct? Pączki?
Mark, I didn't know anything about Pączkis either until I moved up to this area, and I lived in the middle of an Eastern European neighborhood my entire life until I moved up here. So
It is kind of
whatever
a local
whatever
thing.
knowledge there is coming firsthand to me and to you as well.
I think it has spread though, and I do believe even in New Orleans there is quite a they've bubbled up quite a bit in New Orleans with the onset of Mardi Gras and everything else. So that's all part of it. Last but not least on there, we are going to spend just a few respectful moments with the monkey, and that's related to that movie poster on the far right. Is that a movie that you're familiar with, Ken?
Not at all, Mark.
Monsters
No.
Crash the Pajama Party. I got to see if that's available on Netflix when we're done here.
I mean, is the name of the movie Asylum of the Insane? Is
No,
that it?
that's just part. Well, maybe that's part of kind of like those old drive-in classics. Maybe it's
Oh,
it
okay.
might be a triple feature of some kind. I might try to find more about that, but we'll come back to that here in a few minutes.
All right, well, let's get started.
All right, there's the aforementioned golden statues on the lower right that I'm making room on my mantle for. But here's our disclaimer. Everything that we do here is for education and demonstration. No investment recommendation is intended. Do your own homework. Everything we do is to illustrate the purposes, methods, techniques, methodologies of the modern investment club movement, our opinions about how those are best deployed, and that's what we're here sharing with you. So please do your own review of anything that you're interested in. If we happen to own something, we'll try to mention that. That roundtable we've been teasing about is 1 week away, and every year in February, kind of aligned with the Academy Awards and the Oscars, we have our own awards celebration where we give awards for best all-time selection, best selection for the last year, highest accuracy, all that kind of stuff, including tales of pulled pork from Hungarian origins a few years ago. And a Chinese company that we probably have stricken from our memory, Ken. Do you happen to remember the pulled pork company?
Yes, Mark, I do.
But you're trying to forget it.
I'm not even going to mention its name anymore.
I
Okay.
do remember the ticker was hogs.
Yes, it was.
Okay. If anybody out there has any questions or suggestions for future topics or would like copies of slides, our two email addresses are there. Mark R at manifestinvesting.com and kcavula1@comcast.net. Anything else, sir?
No, I'm ready to move on, Mark. We have some good slides this
Okay,
afternoon.
here's our weekly check-in on the general stock market as measured by the value line arithmetic average. You can see that the green bars are pretty much on that long-term blue trend line. And we think that the blue trend line we don't believe in regression to the mean so much as regression to the trend. And that's kind of what this is about, a reversion to the trend, if you want to think of it that way. A reversion
I
to the
like to wa
regression?
I like to watch the last green bar on the slide because we do this weekly and we show a green bar that's in the formation period. I remember last week, Mark, I couldn't see any of that green bar above the blue, and now there's a tiny tip of that green bar moving above the blue growth line right there. That bar won't finish until March 31st, right?
That's correct. End of the first quarter.
Yep.
Yeah, so in this case, it has tucked up above. In fact, it was a little bit higher with our magical January that happened. A lot of the magic in January has kind of receded a little bit.
Yeah, it
Average,
moved up and then back down again. Now it's moved up a little bit again. So
yeah, so
11.6.
the average stock is going to probably now be what we would generally consider to be relatively fairly valued. So that's the whole deal. We do have a winter storm warning out for in some places in Wisconsin and some places in Michigan. They are expecting up to 18 inches of snow, so I had to get the snowman out one more time. And just a reminder, I love the quote from Warren Buffett. That's the actual quote on the cover of the book Snowball. So,
Mark, are they calling for ice down around where you are?
they are.
Yeah, we're calling right now for anywhere from 1/4 to 3/4 of an inch of ice, and that'll play havoc with our utilities. I'll tell you.
Well, maybe we step up the pace here because we could lose internet or electricity at any time. Okay. Well, here's the answer to a question. I hadn't thought about this in a while. Somebody, a subscriber or an audience attendee, that had written a question: why do you pay so much attention to the value line median appreciation projection? Those red dots and red lines on there are basically over time. Those are quarterly numbers, by the way, quarterly reviews of the forecasts of the companies in the value line standard edition. So think of it as the average stock study result or stock selection guide for the companies in the book. Why do we pay attention to it? Basically, our median projected annual return, MyPAR, tracks that pretty well. And we have basically said over the years that the value line median appreciation projection, VLMAP, made famous by Mark Hulbert, is generally a little optimistic compared to what we get with our studies. And I think this shows it pretty clearly that they definitely do track together. So we're doing the same type of stock studies on that universe of companies. Anything you want to add to that, Ken?
Well, no, except that somebody wanted to know how many companies are these tracking, and Value Line's tracking what, about 1,700?
About 1,700. By the time you set aside a few companies, you are talking about 1,600, 1,400 of which are classic industrial companies.
And then Manifest is tracking upwards of 2,500. Am I right there too?
We're actually up to 2,600 because you and your colleagues have snuck a bunch of new, smaller companies in there.
Okay, great.
Okay, about 2,600. So an additional 1,000 companies outside the Value Line universe right now. All right.
Sounds good.
Okay, just a couple. There's the Twitter birds flying around. Just a couple moments to talk about inflation. Yeah, eggs are up. That's driving a lot of the cost of those things you were talking about between Taco Bell and Pączkis and everything else. And it's just been an interesting year. And I found the advice from the Wall Street Journal to be challenging. You can just skip breakfast and save a lot of money. And then I did have somebody mention to me that asked me if that's Abby Jo Cohen grocery shopping.
I kind of doubt that she does her own grocery shopping,
Yeah.
but
And when she buys eggs, she probably buys them, 6 dozen at a time. So probably doesn't fit very well. And then, of course, down here, this appears to be at least temporarily true. If you could find a way to stop eating, you can probably retire in a week. All right, just some fun off of Twitter. All right, Ken, so here's our last moment. We've done a couple of sessions already on the monkey. Have you kind of warmed up to the monkey now a little bit?
Not at all, but he's doing much as I would expect him to do in this new contest. He's down quite a ways down the list now, way out of the top 10 or top 15.
It's way too early for you to declare yourself right on this one.
I'm not declaring victory, but I'm certainly happier to see that he's not going to appear on our top 40 list for a while at least.
I was sitting here the other night with a beverage in my jammies with the fireplace crackling, and I was trying to think, what is it about monkeys that bothers you so much? And I said, this is the type of stuff that we've been exposed to on the silver screen. Blood Monkey, just look at that image on that first movie there. And Monkey Shines. Congo, by the way, is a great movie. Have you seen Congo, Ken? You need to get out more.
These are not exactly the kind of movies I take my wife to, Mark. I don't know.
Okay, so, and then down here you've got Murders in the Rue Morgue with George C. Scott. I was not aware. By the way, these all came off of imdb.com. I wasn't aware that monkeys were involved in the Murders at the Rue Morgue. And there you have it. Some good actors and actresses involved. Then, of course, this one doesn't even need comment. It just doesn't. And then, of course, this one here, I think I'm going to look that one up and see if I can figure out what's going on. But again, the treatment of monkeys by, the media, and, it's kind of like somebody who talks about investing like a dog. Well, everything I know about dogs it's a good thing. It's a compliment. And I'm just going to close with the 3 tributes on the right to King Kong. And probably, although not at the end of the movie, spoiler alert, those are 3 pretty good renditions of King Kong also. So, Ken, I can see where these influences have possibly distorted your perception of the goodness of monkeys.
I'm just appealing to our audience. Don't send Mark any more animals to take off on folks. Okay, let's move on here, Mark.
All right. Well, here is the argument, and again, we're not going to declare victory. We're just going to declare an observation. And I have put forth the theory that the monkeys' selections will more closely track the value line arithmetic average over time. That's what you see in the graph, the bars or the candlesticks. And the general stock market, as represented by the S&P 500, is slightly under that. There are times, fairly notable times, that was the go-go 90s, when the S&P 500, those mega cap blue chips will outperform the average stock. We just went through another one here. But all in all, over time, selecting from small, medium, and large companies, not just the S&P 500, is a winning strategy. We know that. So I just think that as the monkey is loading up his darts and tossing them into the air and letting them come down, they're not, unless you actually weight the tickers on the floor, much like a market cap weighted average, you're going to end up with the value line arithmetic index. So that's just my theory. We'll see over time how that works out. But,
and I agree with you wholeheartedly, Mark.
okay,
I agree with you 100%. It's just that it works itself out in such a way that you have to go through an awful lot of hurt in order to make the averages work out correctly.
Unless you're doing it over a long enough period of time.
Unless you're doing it over 20 years, like this particular slide makes the point.
Yeah, so here is the difference between those two things. And we know that, a suitable mix of small and medium companies, not necessarily on the radar screen at CNBC, you can actually strive for and end up here. And I would go so far as to say, I get it. I get it when Warren Buffett says, this has worked 103 out of 103 times. If you've got 20 years or 30 years, buying an S&P 500, there's absolutely nothing wrong with an 8% return that you see here. We just believe that it's possible to live up here by selecting small and medium companies in addition to that, and being selective about it. And, frankly, when it comes to defending the monkey and the cigar on the upper right, and Goldblum reminding us that chaos is everywhere. If you had if you basically picked 20 companies at random and put them in a shoebox and went away for 20 years, you're probably going to do fairly well. And what's frightening is probably better than the average active mutual fund. It's unbelievable. Because psychology gets involved. So that's it, Ken. I think we can just put the monkey to bed for at least another year, or until he climbs back up the groundhog standings.
Yep, let's put him to bed until he moves up into the top 10 again. Okay.
So we'll come back to this. By the way, that roundtable that meets next Tuesday, that's the performance results for the roundtable that you see here, and we'll be talking about that. All right, just a quick reminder that Kathy Wood's excellent series of technology and disruptive innovation stuff is out there. We talked gently about artificial intelligence. Thank you. I received literally dozens of related articles on the subject. You probably got some also, Ken.
I got an awful lot more than I'm able to read, Mark.
That's my thought too. So again, it kind of comes back. I thought this slide captured it fairly well. This is from a Morningstar article. And I think go ahead, Ken.
I find it interesting, Mark, that you chose to capture this slide and bring it to us today. And this was one of the few slides that I thought had some direction to it that could help me with investing in the next 5 to 10 years. I took and captured the names of companies on this particular chart, and they're going on to our let's study these companies for future growth list for our Wolves Investment Club. I mean, they are full of names that are household names, but they're also full of a couple of names that I didn't know very much about at all.
Yeah, and I think CrowdStrike is one that I want to become more familiar with. As far as I know, it's a internet security type firm. Fortinet, I need to know more about that also. But yeah, this is where some of the AI stuff will be deployed, for sure.
Now, the one that I'm having a difficult time with, Mark, is one of the Dow 30, and that's Salesforce. And I can't really put my arms around what it is that Salesforce does as a business. I mean, the other Dow 30 stocks are pretty easy to summarize in a sentence or two. I think Salesforce defies that kind of classification at the moment, at least. And I think that that's one that we're going to spend some time, at least in one of my clubs, taking a serious look at, especially since it's been pummeled in the last 18 months, and it really is way down from a 52-week or an all-time high.
Yeah,
Very interesting case study, I think.
Yeah, Salesforce, just the nutshell as I understand it, it's CRM, customer relationship management. So it can span a lot of things, taking care of opportunities, fields of opportunity, and Salesforce, literally the type of logistics that goes into the pursuit of opportunities, from proposals, specifications, all that kind of stuff is rolled into it. And the credit that they're being given here is that they have in some way deployed artificial intelligence to that process to help manage that process. So it could be interesting to take a closer look at it. I do think it's a formidable company. And I don't think there's any doubt about that. All right. Just a few more tweets, I guess. There's Abby's back over here too. Probably the inflation crossover. And I just thought that this slide kind of gave me a headache. But it does point out that whatever is happening with respect to month-over-month inflation, it has not been put to bed yet, based on that bar on the far right. And it is kind of interesting to see that motor vehicle and parts, that's this one here, I can't actually show that one. It's in blue. And gas stations and that kind of stuff. What's the purple one? Food services and drinking is this top one up here. Kind of interesting that one kind of took off a little bit. You don't see any sign of that back here in January a year ago. So just a question mark. But the point being, inflation is probably still happening. Any thoughts, Ken?
No thoughts at all. It's beyond my pay grade to try to figure some of this stuff out. I read a very interesting article about rents and how rents are reacting in a I told you so kind of way, but won't really have an impact on inflation gauges for another 6, 8, 10, 12 months yet, because of the concept of leases and how rents move in stair steps rather than in straight lines,
yeah,
or jiggity lines. Yeah.
They do some stuff with correction factors too that muddy
Yeah.
the waters.
Yeah.
All right, let's go ahead and shift gears to Waldo. In these 23 funds, they are listed, ranked by their relative return. Again, that is the amount of outperformance over the period shown for all but one of these. That happens to be a 10-year period. So these are market-beating funds over a 10-year period, and pretty substantial returns. Just to give context, the average actively managed mutual fund checks in at minus 2.4. So these are all above average. And certainly these annual return numbers right down the sweet spot here are nothing to sneeze at. Again, we look at this type of graphic seeking opportunity, either directly in these particular funds. For instance, those top two are very limited. One of the two, I believe, does accept $2.5 million initial position, so I guess that qualifies as limited. Ken probably runs out and buys a couple of those this afternoon. But yeah, these are funds ranked from top to bottom are pretty interesting. And the other thing is, if you dig into, I would actually consider this to be a quite legitimate investment club project to take and divide these up, go back to your favorite desk area, and pull up a fund or two for your club, and then check into these funds to see what have they bought lately. Is there something that perhaps a new discovery, just like we've taught a number of times?
I think another interesting thing to do with a list like this, Mark, might be if you're still working and are involved in a 401k that has an option for significant numbers of different funds that you can choose from. I think it would be to find out how many of these top-rated funds are actually sitting in 401k choices that the average person can add to a Roth for a Roth IRA or a 401k. I'm finding I'm helping my grandson who's just starting his career. He and I are working hard now. He has to make his final choices for his first year on his 401k, and he has a list of about 100 different companies he can choose from. Most of them we've never heard of before, and I'm just a little bit I'm not surprised, but I'm a little bit disappointed in the fact that so many of them are nothing more than index funds disguised with different names attached to them. But basically, they're either S&P index funds, or they might be small cap index funds, or they might be Dow index funds even. But they're basically just plain old standard vanilla index funds. He doesn't get the kind of choices that you might have on a list like this. I don't know. I don't think any index funds make this particular list, do they, Mark?
They actually don't. No, they would be down in that 8 to 10% range at best. So they would be slightly off the chart, but it can make a massive difference, especially to a young person with a 401k, to be able to lock into one of these. You know, and a question that I get from time to time is, are you just performance chasing when you list these out here? And the answer to that is, I don't think so. I really don't think so. What we're looking at here is people who know what they're doing. And you can dig in and actually learn about the people with these type of market outperformances. But at the same time, we come back to, you know, what are the return forecasts? What's it positioned to do going forward? You know, how about the quality? How about the growth? I mean, here's our favorite small company fund down here at 17% growth. And that's one that, if it were open, would be interesting. So I thought what we might do, I've actually worked with individuals who had thought about selling the second one from their retirement plan, that Fidelity Growth Company. I talked them out of it a few years ago, and they owe me dinner. That one has worked out pretty well. So here's what. Go ahead.
On one, Mark, I'm seizing on one that is actually on Ethan's list of possibilities, and that's VUG. And I'm looking at it, and I'm pretty happy with that's on our short list. And we'll need to do some extra work on VUG. Nice par, prove pretty close to it. Pretty decent growth for a mutual fund as far as I'm concerned. So that's one I think that deserves a little bit of asking around about. I'm a little bit taken aback by the very low expense ratio, and am asking myself if there's a certain amount of an index fund attached to this one. I don't know.
Well, it still behaves as an index. It's a little bit more actively managed, but it qualifies as, we're going to actually look at the holdings here in a second. I do own this one. Wendy owns a bunch of it. And it's been
VUG you're talking about,
VUG.
Mark?
Oh yeah, I've owned it for a long time.
Okay.
And
great.
It's also the core. Do you remember back in 2006, Christmas time, we got that call about the bare naked million?
Yep.
Where would you put $1 million? VUG is where we put half of that $1 million. And that bare naked million, maybe we'll talk about that next week. That bare naked million portfolio is now worth, I believe, $6 or $7 million.
Yeah, another one that rose to the top that's on his list of, and he only has 50 or 60 on the list, but another one was that VOT, and that one was completely unfamiliar to me. It doesn't look like it has as nice a set of numbers as VUG, but these Vanguard funds with these very small expense ratios are something to take a little bit of a look at.
Yeah, and if you notice, there's an awful lot of mid-cap mentions at the bottom and small at the bottom of this list, and that is the area that has taken a bit of a beating, just like we were talking about the monkey and the value line arithmetic average a few minutes ago. So
Yep.
there is potential opportunity. I would like to see a little bit more robust numbers here, to chase some of those. But for what it's worth, here is the breakdown of the top 25 stocks held by that Fidelity Growth mutual
Yeah,
fund.
and Mark K is making a point, and we should make it also, that these aren't all mutual funds. Some of these are ETFs. And we're using the term fund interchangeably between the ETF and the mutual fund.
Right.
Uh, so when you see the ticker without the M in front of it, I think that's suggesting it's an ETF. Then
It is. It definitely is.
yeah,
Okay, so here's that fund. Again, a number of household names, um, behaving a lot like a technology index, but you're looking at a decent amount of growth, 13%, quality at 85, and double-digit return forecast. So it's an example of a type of fund. It's got very little turnover. I don't know if I listed turnover on here. I did. Very little turnover, down around 10%, which is almost no turnover at all for an actively managed fund. So interesting stuff. And a place, again, anytime this individual were to load up on something, I would probably want to study it. Okay. Here's a look at one of Ethan's possibilities right here, Ken. This is VUG. It's very similar to the fund we just had up there. I think the only big exception between the two is Lulu is up at the top of Fidelity Growth, and CRM's a little higher up, but fairly consistent between the two. But again, a decent, respectable amount of growth, really nice quality, and a decent return forecast. So could be an interesting source of ideas or direct investment.
one of the things that we had said we were going to do when we are looking at his choices was we were going to make sure we had a list of the Dow 30 with us. And we wanted to know how much of the Dow we were actually investing in when we were looking at some of these larger funds. That would be an interesting exercise to put together. There are a lot of Dow stocks on this particular list here, I notice.
Yeah, and in fact, they'll probably be the higher quality, less cyclical Dow stocks that are going to
Yep.
show up here. Something else
Yep.
that could be reinforced.
You're not seeing the heavy industrials, things like that, but you are seeing the Apples and some of those other higher flyers on the list.
Mm-hmm. So maybe we will come back to the Bare Naked Million and talk about that particular fund. All right, here's your 30-second update on the Groundhog. We're 19 days into the marathon. Neither Ken or I are on the list at this point.
It's an understatement.
I'm starting from a higher position. So if I have that same close that I had this year, everybody's in trouble. Sean checks in at number 23 there. A lot of familiar names. Kim back at number 8. Herb Lemkool will not go away. He's at number 6. And relative newcomer, he's been in the contest for a couple of years, but up at the very top is Ron Thorson out of near Minneapolis. And that would be Ron in the Regal image in the middle of the page, Ken. And he didn't write to me and tell me this, but I think he's probably in that mode very comfortable with coutier as a word. Probably refers to most of us as peasants and hopes to run away from the field this year. But Ron is a lot of fun. He's been active with the Minneapolis chapter for years and of Better Investing. And he actually, I believe he's retired, but he worked at the Minneapolis Fed. So heck of a nice guy. But
Marv,
cool
you
catch
don't
back
have
on here. Orange County.
you don't have a name attached to number 3. Tell us what that one is. Fave 5.
That's just simply screening results from the day of the contest, screening for undervalued stocks oversold using relative strength index.
Okay.
That's just
And how many
the
stocks
listen.
are in that entry? Do you know? Just 5?
5 or 8. I'd have to look.
Okay.
Probably.
Okay.
All right. And, January is magical. I figured we're starting a whole new year. We're actually doing as bad or worse than last year at this point. So everybody step up your games out there. We don't want to have Bill Murray and the groundhog there for the entire year. We actually have
Well,
the lowest percentage here that we've ever seen.
and Mark, to be honest, it did not help that February 1st was one of the best days in the market ever.
I know it. I know it. The complete magic of January is being, we're just backtracking a little bit for a while. All right. Moving on, we do want to get to our main subject for today. Here, just so everybody knows, the Groundhog scorecard is up. I will have the results listed perhaps later today. It might not be till tomorrow, but for the 2022 results. But you can access all of the portfolios. You will find Len Douglas has stocked a whole bunch of those portfolios and is going to help me with keeping them more current this time around this year. There are some unserved tickers that we'll try to take care of here in the next couple of weeks. So take a look there if you want to dig in and see if you can diagnose what's wrong with Ken's groundhog selections for this year. All right. So let's go ahead and finish up with our utility auto pay bill portfolio. And we did say that there was a disturbance in the force a few weeks ago with the acquisition of South Jersey Industries, one of our holdings in the portfolio. So Ken, you ready to go electric on us here? Do we still have you, Ken?
I'm answering, yes, Mark, but I'm answering a question right now to an
Okay.
audience member here, okay?
Okay, here's a quick look at the portfolio in terms of the companies that were chosen. Those 6 companies up at the top. We're going to dig in a little bit deeper and basically the current situation with the fund, and we'll come back to this. But we basically invested $45,000 across 5 utilities, and the goal is to basically write a monthly check to pay the utility bill while maintaining cash in the checkbook. It's further explained here. And this is actually our starting conditions back in May of 2021. And again, the legacy story behind this is that Ken Janke actually used this approach to convince his father to get back in the stock market. His father had gone through the 1930s, 1940s, and all that kind of stuff and was pretty skeptical about investing in general. So Ken basically set up a portfolio that would pay the utility bills for him, and that was a successful thing. So here were the 5 utilities we started with, roughly $9,000 into each of 5. We basically went out searching for excellent quality utilities that paid a decent dividend yield of anywhere from 2 to 4% at the time, and we seeded the portfolio with approximately 3 months of utility bills to be in the checkbook, that $330 in cash. Is that clear enough, Ken, for now?
I think so, yeah.
So here is basically the nutshell of the formation of this. We looked up the published monthly average for an electric bill paying customer in the United States that happened to be $110. And we went shopping for that list of 5 companies, trying to get a dividend of about 3%. So the amount that we had to invest is dictated by that dividend yield. So you can see the math right there, $110 a month, 12 times a year, divided by the 3% or the 0.03. We had to invest approximately 44. We actually went with 45,000 spread across 5 utilities. And we went looking for excellent quality companies. They all were at above 80, most of them above 90. And we did want to try to select, if at all possible, from a diverse group of utilities with decent return forecasts. So we would have a little bit of upside potential also, in addition to the stream of dividends that we're paying the bill. So the 5 selected ones that you see are right there. And like we said, South Jersey served us very, very well, but was taken off the board earlier this month. Any questions at this point, Ken?
No, things are understood by everybody. We're not hearing anything from the questions box yet.
Okay, so what I thought I would do, maybe to demystify this a little bit, put it in ledger form. So the objective here is to buy those 5 companies and have the dividend streams actually make the utility payments. And you see the payments here. Those $110 in red are the actual monthly utility payments, all paid on the first day of the month. So you can see the first one was paid in June 2021. And the objective of the entire demonstration is for this cash balance, which you could think of almost as a checkbook, to maintain a positive number, stay above a few $100s so that we could actually pay the bills. So you can see the math, you can see the cash balance in the checkbook as the months go by. Any questions on this, Ken, or anything you want to observe?
So, Mark, I'm just going to ask a clarifying question. So the whole idea began then with owning 5 stocks at a purchase price of about $45,000 and having $330 in cash sitting on a ledger.
That's correct.
Okay.
So we actually see the cash outflows and the inflows from the monthly dividend payments all itemized here, starting at $330. By the end of the year, that last entry down at the bottom is from December 2021. We had made all of the utility payments, the utility bill payments, since we started, and we had a little more than $500 in the checkbook. Okay? So here's the next period of time, which is basically the first half of 2022. I carried forward the $500, and you can see we continued making the $110 payments, harvesting the dividends, quarterly dividends from the utilities. And then this answers a question that somebody had last month. Yes, we did pay the taxes on the dividends. That's this entry here. We actually had this amount of dividends in 2021 that we had to pay taxes on. So that came off of the cash balance. And then the other notable thing that happened is, back with everything that was going on with inflation, you talk inflation, we actually looked up and checked the average increase in utility bill payments. So we adjusted the amount that we were paying per month by 8.7%, giving us a new monthly amount that we had to cover of $119.57.
Mark, explain the 4/1/2022 entry of $0 from SJI.
Yeah, that's a weird one. South Jersey Industries actually skips quarters and then doubles up in others. You'll actually see where, this one back here was the double up quarter, that $200 coming in. I can't explain it. They paid quarterly dividends. They paid it 3 times a year and then 1 quarter taken off. So this was, if they had paid a dividend, the time when they were scheduled to do it. Surprised me too. I didn't know they did that.
Okay, makes sense.
Okay, so pressing on and looking at the second half and bringing us kind of up to date, you can see that the dividend utility payments have continued through this year, right up until the current situation. We have 343 down at the bottom, but notice we did have a fairly major transaction. The South Jersey Industries acquisition, again, keep in mind that we had invested approximately $9,000 into it. This is the check that they sent us. So we do have a long-term capital gain that'll be payable in taxes next year. But we actually had a huge infusion of cash. We actually took and put $13,000, leaving $239 in the account, and invested it in this ETF, exchange traded fund, known as JEPI. And we promised you last week we would talk a little bit more about that this week. Any other questions on this one, Ken?
So let me put it in different words, Mark, if I could. The $45,000 that originally started out with 5 stocks in cash, which would be a debit to your total holdings, is now been replaced with 1 stock replacing another, but we're still at about $45,000 investment, correct?
Yeah, the total investment hasn't changed. That $45,000, we reinvested everything that we received here. So
okay.
The current value is going to be interesting. We'll pull that up and look at it. Now, the interesting thing about JEPI, it's an income vehicle. We'll talk in more detail about it, but this is a monthly payment. Notice that monthly payment almost pays the entire utility bill. All right. So what is it? It's the JP Morgan Equity Premium Income Exchange Traded Fund, that ticker symbol. It's basically one of the hottest things on the stock market right now. It might be a farce. It might be a fad. Don't know exactly what to think. I've looked at it fairly carefully. What it basically is a collection of blue chip companies in general. So you can see that the quality of these holdings, you can see AbbVie, ExxonMobil, MasterCard, Travelers, Bristol Myers, Pepsi. These are all basically all household names to us. And the average quality is 88, decent return forecast for them, and importantly, a 2% yield if they actually have no enhanced income from the special gymnastics that they do. You're still looking at 2%. Okay, so it's got a decent track record, a short track record, but it's kind of compelling. All right, clear as mud at this point, Ken?
Well, clear as mud. Mark, do we have a turnover percentage on this particular fund up in top? I don't see it.
I'll have to look it
But
up. It's been basically pretty close to zero. It's still relatively new.
Okay, so it might turn over once a year, something along those lines, and then very few names if it does, right?
Yeah, I don't expect it to have much of a turnover rate at all.
Okay.
And once it's in place.
And the choice of companies was made by an active manager?
Yes.
Okay.
So you basically have this fund of pretty solid companies. In fact, I would call that list pretty close to Hugh McManus's vetted list of companies when you look at the top of the list. So there you go. Here's what they do. They basically write covered calls against the portfolio. And there's a bunch of you out there that do this. I've done a little bit of it. It's a strategy that can work quite well. What you're basically doing is harvesting additional dividend yield for the companies that you own. And those of you that are familiar with covered calls, it's actually a fairly benign strategy that you can collect what you could almost think of as insurance premiums. Sometimes your companies will be sold. It's a strategy. It takes some effort and some initiative. I don't find that I have enough attention span and focus to do it. I have proven to myself that I could do it if I wanted to, but I'm not that energetic. In fact, I'm a little bit lazy. So I'm willing to let these guys do this. And they're not doing anything incredibly aggressive. They are using a very conservative strategy, but what they are doing is boosting a 2% yield, again, that the core companies have in the portfolio, and they're boosting it up to these levels of 10 to 12%. Now, there could be months when they do this, but this is their track record so far. Okay? So that is what the payments will be very variable, as you can tell by this chart. But if they vary between 10 and 12, or 8 and 12, or for that matter, between 2 and 12, I'm not sure I care. I just think it's fascinating to watch.
And they pay out every month rather than every quarter, right?
Right. So what I did is I took the first 6 transactions of this year, and then this is actually kind of an interesting ledger application. Everything below the 6th entry there, the stuff that is shaded, is budget. Okay? So you can see all of these monthly potential payments from JEPI, and you can see the amounts. This 104.87 if they do what they have been doing. So those numbers are going to be variable, but those are just budget estimates. But again, what we're watching for, because we actually drew this down a little bit, down to 200, we want this to stay positive. Not only stay positive, but also pay this tax payment, which will come due on April 15th. A little bit bigger payment this year. So it actually accomplishes that, and with a little bit of a margin on it. So again, I am learning, what exactly is going on with this exchange traded fund, JEPI. You can read all about it. We've posted a number of articles on the Manifest Investing website. You can read about it in Barron's. Just Google it and read up on it and attempt to understand it. The way I characterize it is they're basically taking this $13,000 chunk of this portfolio and deploying a relatively conservative synthetic dividend enhancement strategy that basically gives us a monthly payment that almost makes that utility bill payment all by itself. Now, if this is successful, we'll watch it for a few more months. We'll make that tax payment. We'll probably look at some harvesting and redeploying down the road into perhaps a simpler vehicle.
So we can conclude, Mark, that over the time period of this demonstration, through the forecast, which would be June sometime, you've gone from $330 to $443 in your cash accounts.
Mm-hmm.
You've paid the taxes on any capital gains or any movement, and you've paid the utility bills. You've also taken the profit from one stock that was purchased out of the public realm, and then actually purchased a stock to replace it, and all that's been handled with the cash that's in this account. On top of that, go to the next slide if you would. On top of that, the $45,000 is now worth somewhere in the neighborhood of $51,000.
That's correct. So you can see that it's a fairly compelling demonstration of how this can be. This is a little more active than just simply placing it on autopilot because of the variable nature of those synthetic dividends. But they've been so consistent, it's going to be fascinating to watch this, in my opinion, over time. And I am completely comfortable with hiring somebody to do that work. You know, if they can demonstrate that they can successfully do it. There are people in our audience, and there are some people that you guys know well that can that could actually do this on their own.
There's actually clubs, Mark, that participate in a pretty active way in this options trading. The problem is that for a club to do it, it needs to be extremely disciplined, and it needs to have a number of people willing to share the responsibility of making sure that all the transactions are done in a timely fashion. But you and I both know of clubs that are very successful at capturing this options income.
Absolutely, and Hugh McManus has done it. I have done it on a few occasions. So it's not impossible to do. It's certainly very possible. Notice that the quality and the return forecast on the components of the portfolio now are all in very, very nice condition. And
yeah, the type of options trading that we're talking about is not that difficult to understand. The problem is having the time to actually do it on a regular basis and have it carry over for a significant period of time. Life seems to get in the way, and that's what makes this very difficult for an average investor to do on a regular year in, year out basis. It's not something where you do 2 or 3 transactions and you're done.
Yeah, I will confess that when I am tinkering with this stuff, and we'll probably spend some time on that in the future, I pay more attention more frequently to that than I have ever done in my life when it comes to investing.
Yeah.
So it's different. It's just different. All right. Anything else you want to add to that, Ken? Anything that?
Well, no, but I think this is extremely clear for almost anybody. And what would be interesting might be somebody in the audience that would want to take this ledger and instead of buying JEPI, invest in another actual classic utility that fits the mold of the one that was sold, the SJI that was sold, and follow the same thing for the next year with a classic utility in place of the SJI rather than the JEPI, and see where that's headed. I don't want to. I'm not suggesting, Mark, that you do it. You do enough already, but it might be an extremely interesting
it could be some other type of vehicle, perhaps even something higher yield anyhow.
Yeah, but well, I'm just suggesting they maintain just the utility idea and see where that leads you. I'm reasonably certain after watching this proceed that even another classic utility with a dividend yield down around 2, 3, 4% is going to result in something that people are going to be quite happy with as far as paying the utility bill and having a nest egg, which is growing at a fairly slow rate on top of that.
Yeah, I will confess that I did this just because it forces me to understand this better. And it's going to actually, we'll introduce the subject of QQQX. QQQX probably within a couple of months. Same
That's
type,
the
same type of fund
that's the
as Jeppy, only based on the
that's the
NASDAQ stocks.
Nasdaq. That's the Nasdaq 100, only with some options trading attached to it. Is that right?
That's correct, and it might be
Okay.
intriguing to look at that also as
Yep.
how's that done
Absolutely.
and what's it worth. So it's just
Absolutely.
again, it's my excuse to pay attention to this. So for what it's worth. All right, here's our reminder that we do archive all of these sessions on YouTube. Just search under Manifest Investing. Please invite your friends and family to check this out. You can do an appetizer, check out one of the sessions. I think today's topic is fascinating. I suspect that Ken and I will be talking 401k and Ethan's options in pretty much detail in the future also. These are all worthy topics. Let them know that it's out there. Please subscribe, and we'll let you know anytime we add content to this stream. The roundtables are here too. That roundtable is coming up in 7 days, and I am dusting my trophy mantle. All right, here's our reminder that on March 14th, we'll be talking about these two books. I've made it 90% of the way through the first one, and thank you, Matt Spielman. This one is really worthy. And we'll actually be looking at both of these at the same time. Annie Duke's book, a little bit different. She's a extremely respected poker player. So we'll be doing that. So take a look at those. Here's a reminder that a week from today, we will be doing the roundtable.
Mark, we're getting a very interesting note from Nick. And he says, besides the options that we talked about for Jeppy, they also use equity-linked notes, ELNs.
Yes.
Are you familiar with what those are?
Roughly. I don't think I could describe the actual mechanical details of them, but it is a way of investing in segments of the market. They probably have to do some of that in combination with some of the options trading that they're doing.
Well, they're very short term and Nick claims there's a lot of turnover for those ELNs, but they do make up about 20% of the Jeppy portfolio. And they write their covered calls through the ELNs, and now we're wading in a swamp where I'm above my knees and sinking. So I'm not going to be able to explain what Nick is talking about, but
Yeah.
he's suggesting it might be a little bit more complicated than it appears on first blush, you know?
Yeah, it is a little bit more complicated. They're basically taking this family of stocks, which is basically the foundation of this investment vehicle, and they're proxying it up and probably writing calls options against those proxies also. I imagine they do some direct option writing against these positions also, but the notes are, I mean, they sound mysterious and perhaps fall into the John Bogle "thou shalt not use derivatives," but I just don't feel the same way about these as some of the other stuff that goes on.
Well, it's an experiment right now that we're demonstrating, and it's a very interesting experiment. So
We will
we're
learn more about it as we go. I mean, one
I,
of the
I don't think we're putting anybody's cash at risk at the moment. So
no, other than I have personally parked some money in Jeppy of personal funds. So again, as part of understanding it, part of our mission here is to whether or not you choose to do it yourself. It's always good to understand this stuff, and that's what we're here to do.
absolutely.
All right. Okay, Kevin Gologly apparently wants to slide in there all the time, so we will honor his wishes. That one might show up a week from today at the round table. It's like impossible. My computer programs are all embedded with these things. All
I
right.
gotta get a picture of a Cleveland Polish sausage at the Western Market and get that up in this slide deck here. You
And
know,
for those of you that are out there saying, "What he's talking about hot dogs? How related could that be to investing?" It's in the portfolio. Ken actually demanded that it increase in value a few months ago. It has. So you're welcome, Ken. Um,
well, okay, all
we're not going
right.
to talk much about it. There was one major change. Ken, you asked for a scale change. Two people actually independently asked for their own scale change. And all they wanted to be able to do, we were actually tracking $1,300 invested. They wanted to switch it to let's invest $1,000,000 so that we can tell when we go below the original investment and when we drop down to 800 or whatever. It just makes for a different comparison. It just changes the numbers. Makes it
Right.
easier to tell where the starting point was.
The outperform is still very evident on the graph here. So,
Yeah, and we don't want to jinx ourselves.
yep,
Walker
yep.
and Dunlop reports tonight. Hopefully, this number will be better the next time we look at it. Although,
We still want to keep kicking ourselves about Semler Scientific. I don't know. That must have been an idea that neither one of us had. You know, Mark.
no, I had it, and we're still good. Look at that 171% expectation over the next year.
Okay, that's believable.
Okay, we lost this one to our internet dropping out last week, so I had to bring it back. $10,000 invested into each one of these advertisers in the Super Bowl a year ago is not a whole lot of fun. So
and thinking back to the Super Bowl advertisers for this year, I would imagine similar results when we do this a year from now as well.
yep, be careful out there if they're all over everything. Here's a quick let you guys know for the first time. We will be putting this up in a number of places. Ken and I will be giving a presentation to the American Association in Troy, Michigan. This is an in-person, face-to-face meeting in Troy, Michigan. So those of you that are within driving distance, we're going to have some fun talking about a lot of this kind of stuff and just augmenting some of the other lessons that we've learned over the last few decades. All right. And Ken, I think that's it. You got anything else?
No, I'm ready to call it a day for today, and come back again next Tuesday for probably a pretty abbreviated version if we're going to get ready with our black ties and everything for the evening. But if you get a chance to join us next week in the evening, it's always a lot of great ideas and a lot of very interesting things coming up on those yearly roundtables where we're looking at past results and looking forward to what the future might hold. So join us if you possibly can.
And we'll just leave us with the immortal words of Ron Thorson, definitely related to the realm of investing. It's good to be king. All right,
Good
Ron.
night, everybody.
Be good. All right. Thanks, Ken. Good
Thank
luck
you,
out there,
Mark.
everybody.
Bye-bye.